Welcome to today's video technical update presented by CMS Forex. It is Wednesday, January 6th, 2010. I'm Fan Yang, your technical analyst, and I'll go over some developments in the Forex market. Not much has changed for the greenback after it has lost its steam. We'll take a look at the euro dollar, pound dollar, and the dollar Japanese yen pairs. Commodity currencies such as the Aussie and Loonie are even stronger performers against the greenback as crude oil has been surging. I'll also cover the euro pound and the pound yen pairs. This video is being prepared at about 5:20 p.m. Eastern Time ahead of the Asian trading session. Starting with the euro dollar pair, as I mentioned, not much has changed. You see, the last couple of days has been just this within this consolidation pattern. So basically, our 1.45 still remains as resistance, and this area 1.4250 area still remains as support. Looking at the 4-hour time frame, we see that the market here is in the sideways ranging action, but we do see some improved momentum, so maybe we will get some further correction, and we'll keep monitoring this pair, see if it can reach any of these, maybe a 50% retracement of this decline, and from there we can look for some topping action. And if there's a bullish signal from there, then we may have a continuation. And if we do have a continuation, the swing projection is likely to be around 1.38. Not much has changed for the pound dollar pair neither, but we do see today that we have a pause of this decline, and in fact today we had a slight gain on the dollar from the pound. Looking at the 4-hour time frame, this outlook of a Gartley is still valid, and looks like if there is going to be a trigger for this outlook, it would come in the Asian session. So if this bottoming action here can be broken, then we have a likely test of this 1.4350 area at the 50% retracement, and from there topping action with bearish signal would suggest further decline, and further decline would be targeted to the 1.57 area. Next is the dollar yen pair, and we see that the market has been acting exactly the way we anticipated here, topping off at 93. Now the market may not be done with this retracement yet. Looking at the 4-hour time frame, we see that one leg of the retracement is complete, and now we have some further rally, but again, we're testing this 93 area, so if there is a decline from here, candlestick action suggests it might be ready for that. We might have a second leg to this retracement, which you see here. If we extend it, we hit this 61.8% area, slightly below 91, and from there, if the market supports it, then our bullish outlook is supported, and a break of this 93 area and this trend line may be more probable. But again, we are still in a declining consolidation kind of mode until this is broken. But being supported here does improve that the chances of that. The US dollar Canadian dollar pair has been weak due to Loonie strength, which is on back of surging oil prices. Now here you see our dollar Canadian dollar pair pressured and approaching, or actually it's hitting this important support here. Okay, looking at the 4-hour time frame, we don't have any bottoming action yet, but we do see some kind of, it's possible, sort of a slowing down, deceleration here. And meanwhile, we do see a possible divergence forming. That is, if the market can hold above 1.03. So if the market can hold above 1.03, and if it rallies in the Asian and European session, if it could break this trend line, then we may have a test of these trend lines here in tomorrow's session, in the US session. And if that breaks, then we have, see, that trend line is this trend line. If that breaks, then we may have a retest of this previous high here. You see, this trend line is basically approaching the apex of this congestion pattern. See this triangle here. So it's nearing the apex, and if there is a rally that could break this, we may want to watch to see if the market can break this trend line as well. For a more long-term look, you see this could all be noise, and the market could just be continuing to consolidate. Therefore, if you want a signal for more intermediate term, long-term bullish action, you have to break this 1.1 area as resistance, and that would probably be coincident with our 200-day moving average here. So at the moment, the market continues to consolidate or be in a congestion pattern, but we are at support, and very aggressive traders may look for bottoming action here for a bullish outlook, at least in the short term. And if we do break this 1.1 area, then we have a more longer term bullish outlook. As I mentioned, crude oil has been rising. It's been 10 straight sessions of gains and is at a 15-month high above 83, closed up 83 today. So that had to do with why the commodity currency, such as the Aussie and loonie, the US Canadian dollar, has been gaining on the dollar. And you see that reflected here as the Aussie has been gaining on the dollar more aggressively than other pairs. But we do hit our downsloping resistance, and the market is showing that it might break. So our bearish outlook has to be reconsidered, but it doesn't have to be invalidated yet because there's no sustained break yet here. And our stochastic isn't overbought, so we may want to give the market a couple of days to show whether it wants to continue rallying or whether it has a lot of selling pressure here. Looking at the 4-hour time frame, we see that the market has been overbought for a while, and this two-wave structure seems to be invalid. We seem to have another wave here, so maybe we may have a further rally to the 78.6%. Let me see if I could show it here as well. 78.6% of this, so somewhere around 90.93. If we see topping action there, our bearish case is still valid. But if it continues, then we are basically maintain this ranging action, and there's no reason why we would expect a bearish mode. It would basically be a ranging mode if the market breaks above this 0.93. Following up on the pound-yen pair, yesterday we noted that this may be, this reversal back down may just be a throwback. You see in the 4-hour time frame, this reversal back down hits the apex of our congestion pattern, and if the market can rally from there, then this would be a throwback. And a throwback means that we have a continuation. But there is a possibility of a second leg coming down. Now, looking at the 1-hour time frame, this is just to show you that if you had come in here, if you had long the pair here, this would have been your reward to risk ratio. This is a 3 ATR before your power line. Basically, you would be about 215 pips away from your trigger here, and your targets, your retracement target, which assumes further decline, is here at 149, 149 area. Your second target here at 150.70 area is basically the previous high here, 400 pips, and that would be 1.86 to 1 reward to risk ratio. Up here, which is, I'm going to go back to daily, which is up here, 153 area, and the previous high in the intermediate range, that would give us 700 to 215 reward to risk ratio. And that wraps it up for today. Visit fxtimes.com for daily updates and technical and fundamental analysis, as well as educational live events. Once again, I'm Fan Yang, your technical analyst here at CMS Forex, wishing you good trading.